It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, smartest guy in the room, Michael Becker.
Hey, Paul.
Better known as the mayor of Beckerville. Mr. Mayor, how are you today?
Doing well. We have a special podcast today, don't we, Paul?
We got Jonathan Ferrell sitting in. So we have the smartest guy in the room, the second smartest guy in the room, Jonathan Ferrell, who is with Old Capital. Jonathan, thanks for hanging out with us today.
Thanks, guys, for having me.
I got to say, Paul, this is the first time you called me the smartest guy in the room when it wasn't just you and me in the room. So that's good. So we feel honored to have Jonathan
You're
in here.
Smarter than two people.
We hijacked Jonathan's office for the recording of this podcast, so we thought we'd bring him in.
That's great. You'll have a chance to meet Jonathan if you want at the speaker series in March. Tell us a little bit about that.
Yeah, so on March 28th, we just had the one recently at the Grapevine Convention Center on February 15th. We had Mark Patton and David Kahn come in and give a talk. So we definitely appreciate those guys coming out. But the next one we have coming up, we're especially excited about. It's going to be on March 28th, the Grapevine Convention Center, which is near DFW Airport. We're going to have Dr. Mark Dotzauer, who is the former chief economist for the Texas A&M Real Estate Center, come out and give kind of the State of the Union on the real estate market nationally and in Texas. So he's a very entertaining, great speaker that we're very fortunate to be able to offer to you guys for free. We just ask that you go to the oldcapitalpodcast.com website and sign up for it. They usually, cost, first time I saw him, cost me over $100 in a ticket to go see him. Thanks to Uncle Paulie here. He's going to subsidize Dr. Dotzauer's fee for everybody.
Yes, be more than happy to subsidize it. But truly, you really want to go see this guy because everybody listens to him. He's a national economist with a sense of humor and kind of breaks everything down so people understand a little bit about what's going on. So good thing to go see. So let's kind of talk about what's the question. And we have, again, the second smartest guy in the room, Jonathan Ferrell. Let's see if you can help me out with this question here. Michael, how do you come up with your assumptions in underwriting deals? And do you use a sensitivity analysis? If so, what scenarios do you use? And do you model out of negative rent growth? And what's the rate of return? So,
yeah, I'll kick it off. I'll start it. There's a lot of questions there, but really kind of coming down to how do we underwrite these deals? What kind of assumptions or how do we come up with them? I mean, really, we just try to use as much as we can market data to make a lot of assumptions. I mean, when you go in and buying these deals, you have historical financial statements, so you kind of see how the seller operates it. You see a rent roll, you see what their scheduled rents are, and then you can actually see what they actually collect. So, you had a good reference point kind of to start out there. And then, we subscribe to data services like ALN and CoStar. And then on there, they do market rent surveys and kind of give you what the competitor properties are charging. So, we're trying to target deals that are below market rents. And we try to then, figure out what it's going to take to get from the below market rents to what all the competitors are doing. So that's typically when you have your capital plan in place to come in and improve the interiors of the unit or the amenities, the signage, or whatever it needs to bring the subject property up to what the competitors are doing. And that's the information that we base our assumptions off of. To your sensitivity standpoint, you need to have some sensitivity in there. What's kind of your break even? One of the biggest things that us bankers and sitting around the microphones right now use, certainly debt service coverage ratio is a big thing that we all tend to look at because that really tells you how much more operating leeway do you have before you ever come in and have a payment issue.
Jonathan, what is sensitivity analysis? What does that mean for being a layman?
Yeah, so sensitivity analysis is going to be something where you're stressing the interest rate, you can stress the amortization, and stress the leverage of different properties. So
again, what does that mean?
Again, a fairway transaction is going to be 75% leverage, pick an interest rate, 5-year fixed rate, 5%, and a 25 or 30-year amortization. So you want to see how the property is going to perform with more favorable terms and also adverse terms. So, again, optimal terms, you would get a 10-year fixed rate from Freddie with a 30-year amortization and some interest-only period. If it doesn't qualify for Freddie, then you're limited to a more of a bridge transaction, which is what my background is. And so 5-year fixed rate, how's that property going to perform on a 5-year fixed rate, on a 20 or 25-year amortization, and a lower leverage? And so just kind of seeing what those kind of play out for returns.
Or what happens if, from an operational standpoint, if the market rental rates fall 5% or 10%, or if market occupancy is 95, but you have a disruption in the local economy, you can only have 90 or 85 or whatever. So those are some of the things that we try to make sure we go in and sensitize.
Yeah, there's some theoretical things that we have to plug in there. So if you're looking to, say, get greater than, say, 1 year of interest only on, say, a Fannie Mae loan, we look at the exit analysis. And so what's going to happen with the unpaid balance by the time this loan comes to a maturity? So some of the things that we stress out, again, stress out really means make up, to kind of figure out what it's going to look like. We maybe have the interest rate being maybe 1% or 2% higher than what it is today. We keep the 30-year amortization in there, but also we maybe only have income go up by 2%, expenses may go up by 3%, and maybe have the cap rate go up by 1%. So we're kind of figuring out, can this person who owns a property today, are they going to be in a position with that unpaid balance, because it's a hard maturity, are they going to be able to pay that loan off? Or, so Fannie Mae's trying to figure that out. So sensitivity analysis is very important in transactions. In this case, to try to get more interest only, because if you get, say, 3 or 4 or 5 years interest only and you have a 12-year loan, that means you have to start paying down the balance from years 5 to 12. So that's an important thing in sensitivity.
One thing maybe, Jonathan, since we have the pleasure of having you here, we always talk about apartments, but, you have a background in multi-tenant, office, industrial, and retail. So what are some of the things as a potential investor in one of those asset classes that are kind of different? What are some of the things that the bankers look at or owners of those deals look at that are definitely different from the apartment space?
There's a lot of similarities between all the property types. It ultimately comes down to rental income, expenses, and then occupancy of your property. So that really fits across the board. You're going to have different leverage points for each of the property types. Multifamily generally is going to be the most aggressive. Other property types, so retail, office, industrial, those are going to be 5 to 10% lower on leverage points. But yeah, again, you've already spoken to it, Mike. You look at what the market is for those types of property in that specific submarket of that property.
And you have to budget for things like leasing commissions and tenant improvement allowance. So, Matt, maybe you want to expound upon that, because that's probably a relatively foreign concept to a lot of people that do apartment complexes.
Sure. Yeah. So on retail, office, industrial, certainly on a value add or reposition type of strategy, there's a vacancy or a short-term rollover of the current tenant base. And so it's a lot more expensive to put in a tenant for one of those properties versus a multifamily property. So you want to account for that. Certainly when you're buying it, put it into your capital budget of current leasing costs. So again, tenant improvements and leasing commissions. And then also what's your expectation on your tenant rollover. A lot of lenders will discount rental income that is coming in from tenants that are going to mature in the next year or two, as much as 75 to 50% of their income. So when they're sizing their debt service coverage ratio, they're going to take that into account. So again, it could impact loan dollars, but they also want to see you accounting for it in your capital budget. If you don't, a lot of lenders will actually escrow or sweep cash flow every month to address those for you.
Yeah, in apartment buildings, if we have a 100-unit apartment building, we have 100 different tenants. In office and retail, you may have, if retail strip center, you may have 5, 6, 7 tenants.
Sure. And if you have a single tenant triple net retail center,
like a Walgreens.
Yeah. So, how do you think that occupancy sensitivity looks? It's either 100% full or 100% vacant.
Pass or fail, right?
Exactly.
So, and then on the office and retail stuff, Fannie Mae loans are not available. Fannie Mae is only, and Freddie Mac are only for apartment buildings, or apartment buildings that have some form of retail involved with it that's less than, say, 20 to 25% of the total income. So it's called kind of a mixed-use property. If people want to get more information, Michael, about what you do in your business over at SPI, what's the best way of getting a hold of you?
Yeah, the easiest way to get a hold of us is go to our website, which is www.spiadvisory.com. It's SPI like spyadvisory.com, and then you can find contact us page and fill out a form. And we certainly are always happy to have a conversation with listeners of the podcast if you want to get to know a little bit more about what we do at SPI. But the bigger question is maybe, Jonathan, how do people get a hold of you? I know you have we talked to James quite a bit on the podcast. We've been on the team for about 6 months now?
Yeah,
or so.
6 months.
And you have a definitely more diverse background than, say, Paul and I do, because we're just apartment junkies. And you have a lot of office, industrial, retail. Those are things we don't talk about a whole lot on our podcast here. But if anyone's looking at doing some sort of other income property besides the apartment space, Jonathan would be the person I always refer people to if they ever call me about it. So maybe give a little bit of information about how they reach out to you.
Yeah, best way to get in touch with me would be an email. It's my initial J and then Ferrell, F as in Frank, ERRELL, at oldcapitallending.com.
So that's the second smartest guy in the room. And now, Michael Becker, thanks for being the first smartest.
Well, I wonder what we're going to call you now, Paul, so I don't know.
I'm just a loser. So thanks for listening to Ask Mike Mondays with Michael Becker and now Jonathan Ferrell in this podcast episode. So thanks very much. I'm Paul Peebles. Have a great day.